Good evening, friends. This is your own CPA, Sanjiv Gupta CPA. Today, I want to start the show with a request to all the people who are not vaccinated to please go ahead and do vaccination and stay away from the misinformation that is going around. It is very surprising the kind of misinformation being circulated, like maybe a chip inserted on your body, on your arm, or some kind of religious belief. It's a time to reevaluate all those misinformation and make sure that the information that is coming to you is right and is accepted in the community at large. It's a time to look into all those and get vaccinated as soon as possible. Delta variant is rising, and we are coming to the old year in number of cases, and it's just shy away of closing the entire country. It's not closing by far, but the cases are rising, and it's time to get really look into this and be careful about our environment and the surroundings and our neighbors and our family friends. So just go ahead and get vaccinated as soon as possible. In the dollar topic of the show, before we go to the dollar topic, today I want to give some dollar update relating to what happened in the U.S. Senate. Today, U.S. Senate, they passed the Infrastructure Investment and Jobs Act. While we are still waiting the final version of the text, but from our sources, what you read from the bill, it will repeal the employee retention credit for the last calendar quarter of 2021, excepting for recovery startup businesses. That means for business owners who are claiming the ERC, we call it employee retention credit, very popular, by the way. If you're a business owner and there's a reduction in revenue by more than 20%, very less to the quarter one of 2021, compared to the quarter one of 2019, if there is a reduction by more than 20%, definitely qualify for the ERC, which is a valuable credit. Of course, you get the money in the bank. It's based upon the Form 941, amending that 941 Acts. So what it says in this Infrastructure Investment and Jobs Act, you can claim for third quarter as well. Of course, we are waiting for, like I said, we are waiting for the final version. Excepting for recovery startup business, you cannot claim it for the last quarter, means the fourth quarter of 21. So we have to wait for details on the third quarter. So business owners, it's an excellent opportunity for you to avail this exciting benefit, which is there in this Jobs Act, Infrastructure Investment Jobs Act, provided get passed in the House as well. One important aspect in the Infrastructure Investment and Jobs Act relates to cryptocurrency reporting requirements. It expands the cryptocurrency reporting requirements for brokers starting with 2023 tax year. By the way, to cryptocurrencies, Bitcoins have come back to those old levels of 46,000. It looks like they ignored what is there in this act. It's a loosely defined brokers, what constitutes brokers, how the reporting will take place, but they're looking at those reporting for those cryptocurrencies starting from 2023. Absent from this bill are increases in tax rates for capital gains corporations or the top income tax bracket. By the way, these provisions are all being debated as part of the budget reconciliation bill, and we know that they have also passed in the Senate. Of course, this $3.5 trillion bill, budget reconciliation, which has been agreed to by the Senate, still has a long way to go, long way. But we have to keep our focus on this year, 2021. If it gets passed, you are looking at increasing tax rates. And we are aware of the President Biden tax plans. I have a webinar coming up on August 21st, which is about mid-year tax planning. It's all about this year relating to the tax rules as it stands as of now. You have to take steps, whether it's individual tax filers or a business tax filer, to take steps relating for this year. We are getting a lot of consultations relating to tax year 2021 when it comes to capital gains, when it comes to real estate, when it comes to stocks, when it comes to uh, business owners, K1s from different corporations, setting up the corporations. Economy is doing great. Last month, there was a great jobs report. Whether the Delta variant will have a dent in the economy, we have to see and wait what happens next month. By the way, the UK, where the Delta variant shown an upsurge last month of July, last month of July, has shown a downtrend. It looks like for in the US, it's going to go more up. Maybe it comes down in next month or so. We'll see. We'll wait and see. So we have this webinar coming on August 21st on media tax planning. If you are a listener who wants to get the benefit of the planning strategies, please join us for this webinar. For registration, you can go to my website, sanjivcpa.com, SANGIVCPA.com. We already have about 150 registrations so far. We have limited capacity. We keep on expanding it. Of course, with a lot of people going on the Zoom and other things, and the capacity always shrinks with a lot of people out there. So I really request the listeners, if you are interested in this webinar, please join, please subscribe, please register as soon as possible without delay. So the webinar is happening on August 21st, Saturday. Time is from 10 to 12, 10 a.m. to 12 noon, and you'll get a lot of interesting strategies relating to individual taxes and business tax filers, as well as reporting requirements and compliances, which are increasing rather than decreasing and decreasing. This is Sanjiv Gupta CPA giving this show, bringing this show on Wednesday, every Wednesday, 6:30 p.m. to 7 p.m. Listeners, if you have any tax question, this is a time to connect with me on air. Studio lines are open. Studio number here is 408-912-5038. 408-912-5038. 408-912-5038. My firm, Sanjiv Gupta CPA, has offices in Fremont, Sunnyvale, and Pleasanton. And I have a team of experienced CPAs, CAs, EAs, and accounting professionals who are well versed not only on US tax rules and regulations, but also with complex Indian tax rules and regulations. Complexities arises in terms of treatment of various items of income and expenses on the India tax returns and how it relates and reports on the US taxes and getting the foreign tax credit related to 1116 and the ownership of foreign entities in different forms, 5471, 5472, and on top of it, guilty taxes. You really need an experienced professional, accounting professional who have the knowledge and understanding of the rules and regulations that exist in both the countries. Myself, not only a CPA, but also an experienced chartered accountant, having practiced in India for 12 plus years before coming to US. Our team have really helped all the clients in areas of PPP, which is a big program. A lot of people, a lot of our clients took advantage of this PPP loan from the government, PP1 and PP2, and we have really helped them to get the forgiveness done also. We have a lot of valuable information on the website, sanjivcpa.com, SANGIVCPA.com. If you have questions, tax question at this time, connect with me on air. The studio lines are open. Studio number is 408-912-5038. 408-912-5038. And if you have any question that you want me to address on this show, you can email me at Sanjiv, SANGIV, Sanjiv at sanjivcpa.com. I have a caller here. Let me take this call. Good evening, this is Sanjiv Gupta CPA.
Hello. Yeah. Am I on the air now?
Yes, let's go ahead with your question.
Yeah. I got a question on how do I handle a capital gains tax on sale of a house with a lot of equity, and I'm at the highest bracket in terms of earnings and so forth. What is the total federal and state number for capital gains that I would have to pay?
Okay, so before I go into details of answering that question, I have a quick clarification on that question. Are you looking for the sale of a primary home or looking for a sale of
Primary.
an investment primary home? Okay.
Primary, yes.
So when we talk about primary home, first of all we have to look at the exclusion of the gains. So that exclusion is based on whether you've owned and used the home for 2 out of 5 last 5 years, not any 5 years. 2 out of last 5 years where you're owning and using that home for your own primary residence. If yes,
Check
if the
that.
answer is yes, you can get the exclusion up to a gain of $500,000. $500,000
Right.
gain will be excluded from if you're married filing joint and single is half of it. That's first time. That's
Yeah.
the first exclusion. Now comes
Okay.
secondly is what happens if your gain is more than $500,000? What happens then? Well, if the gain is more than $500,000, the extra gain will be taxed. If you are in the highest tax bracket, I'm assuming the highest tax bracket starts around 550 married filing joint, where it jumps
Yeah.
from 37%, 35% to 37% as of now.
Yeah.
So in that case, the federal long-term capital gains rate jumps from 15% to 20%, and there's a Medicare tax of 3.8%. So 20% federal tax rate, 3.8% Medicare tax, which is Obamacare tax on higher investment income of more than $250,000, which is there in this case when your income AGI exceeds $500,000. So 20% plus 3.8%, and the California comes into picture, it can range from 10% to 13%, depending upon what your income bracket is. If it's more than $1 million, it's around 12%. So roughly you're looking at 23.8% for federal taxes. California taxes can be anywhere from 10 to 12, roughly around 35 to 37% tax you have to pay in total on that gain, okay? On the extra gain.
Yeah. Yeah. So can I just ask a follow-on question? In terms of upgrades and modification to improve your homes and all that, you can take that as reducing
definitely,
the
101%.
total, right?
All the renovations, improvements that you've done so far, provided you kept the receipts. Now, a lot of people, they do the upgrades, but they don't keep the receipt, or they pay it in cash, and they don't have proper documentation. So that will not be allowed. So basically, you can deduct all those if you have the documentation for those expenses. Definitely.
Sure. Thanks for that. And there's no cap for that, right? In terms of how much you can.
No cap. Absolutely no cap. So you can deduct the selling expenses, which are improvements to the property, and selling expenses like commission, closing costs. Closing costs for the property also can be deducted from the gain as well.
Okay. And how soon the year that you sell the house is the same year you'd have to pay the capital gains, I assume, right?
Yes, and make sure when you sell that home and there's an extra gain that you're going to pay taxes on, you do estimate tax payment, or you can need to make the payment by January 15th of next year. If don't wait for filing the don't wait for the filing for paying with the filing the tax return, because you're subject to penalties and interest if you don't pay by January 15th of that year. Okay.
Okay. Great. Thank you very much, Sanjiv.
Thank you for the question, and it was a very interesting question. Listeners, if you have any question like this or any other tax question which is burning in your mind, looking for a solution, looking for a CPA, not able to get hold of one CPA because the CPAs are busy, it's your time to connect with me on air. 408-912-5038. 408-912-5038 is the studio lines which are open. My website is sanjivcpa.com, SANGIVCPA.com. If you are looking to connect with me on the webinar, which is happening on August 21st. It's on mid-year tax planning 2021. You can register on my website, sanjivcpa.com. And we already are up to 30%, like 40% of the capacity. Please register there. Now let's talk about the dollar topic of the show, which is about for S Corporation LLCs. We have been talking about this for last 3-4 shows. The reason why I'm still going into this topic is I want to really bring out different areas where it's important for a listener who has a corporation, who has a business, to understand what else he can do to take the benefit and what steps he can do in case he gets into kind of situation. We have callers here. Let me take this call. Good evening, this is Sanjiv Gupta CPA.
Hi, is this?
Hello, this is Sanjiv Gupta CPA. Hello.
Hi, I have a question about short-term capital gain tax.
Yeah, go ahead.
Um, Assuming like you have a big short-term capital gain tax for this year, what are the opportunities? Like there is something called opportunity zone, and
It's a ve- it's
those
a
kind
very
of
good
things.
question, and let me summarize it because it can take the full day, or you can connect with me on webinar for media tax planning. But just to summarize this, if you have a short-term gain, you have opportunity to avoid the tax by investing into 1031 exchange if that short-term gains relates to rental or investment properties, not primary home. You can look into deferring the tax by investing in qualified opportunity zone funds. But these are only 5 years of 5-year plan because this goes out by 2026. Remember, this plan was set up by President Trump and President Biden. Current president doesn't like what he does, so what he did. So anyway, so this might go off after 2026. So still, it's an opportunity to invest and grow the money tax free. So this is an important plan, but you have to understand all the things relating to qualified personal zone funds. Or you can, to avoid the tax on short-term gains, you can look into different kind of investments and other things which can bring losses from those business and set up those gains. So definitely, there's a lot of things you can look into. But yes, there are opportunities out there. You can still plan it. That's why we have a webinar coming up shortly on this. Okay.
Okay, yeah, I mean this capital gain tax is mostly from the stocks. So I
Yes,
think
yes. So
1031 and all those things don't apply, right?
yes, so short-term gain is treated as ordinary income. So no matter it comes from
Okay,
anywhere, it can come from real estate, can come from stocks, does not change anything. Okay.
okay, thank you.
Thank you. Thank you. I appreciate that's a very important question. And it would have taken me at least whole day to give the training on that one. That's why we had this webinar, media tax planning on August 21st. We have a caller here. Let me take another call. Good evening, this is Sanjiv Gupta CPA.
Yes, my name is Bhavish. I have a quick question. I'm planning to remodel my house next year, basically
Uh-huh.
tearing down the entire house and rebuilding it. So, in terms of renovation cost, it's going to be $500,000. So, what can I do as a planning to deduct next year? What sort of things I can deduct?
So this home, I believe, is a rental home, not
No, it's a
primary
primary
home.
home. Primary home.
So when you do any renovation or improvement to a primary home, you have to,
Uh-huh.
first of all, you have to keep the receipt for those, and you have to keep
Uh-huh.
the receipt for those expenses till the date of your selling. In fact, even after selling that rental home, you have to that primary home, you have to keep it for 3 years. So you have to keep the receipt, make sure that you keep the copy of the checks, and that renovation will be added, the improvement will be added to the cost basis of your property, which you can deduct at the time when you sell it from the gain realizing from the sale of that property. Okay, you will not get the
Yeah.
tax benefit right now, but you realize the tax benefit when you sell that home and there's a gain exceeding $500,000. Okay.
Yeah, so in the current tax year, the next year tax year, I won't get like energy efficient technology that I put in. I won't get the tax deduction for that.
No, if you're doing an energy efficient or solar installation, of
Yes.
course you will get, but there's energy efficient deductions, very limited amount, and solar also
Oh,
is very limited, up to 26% this year. So of course you'll get those deduction for in case they qualify for those deductions. Okay.
okay. And it's limited to 26% of the total cost.
Yes, but it's for solar energy efficient is still lower amounts. Okay.
Okay. Okay.
Thank you.
All
Thank
right.
you for
Thank
the
you.
calls, and definitely those are very interesting calls. Very effective calls, by the way, and it really helps other listeners to get information on those areas. So, listener, if you have any other further question, we have coming to. I've not even talked about my topic, but if you have any burning question at this time, we have about 5 minutes for the show. You can call us. The lines are open: 408-912-5038. 408-912-5038. So, coming to this LLCs and S corporation, which is our topic. So we were talking about 401k plans, and I talked about SEP IRA plans. There's one important plan for the S corporation and LLCs, which is known as defined benefit plan. And this defined benefit plan is a kind of a plan that helps the owner, the shareholder of the S corporation, member of the LLC, to put a lot of money in retirement plans. It's a catch-up plan for those people who have not put too much money into retirement or forget to put money into retirement. That's why we call it a catch-up plan, where you can put a lot of money in retirement, maybe 250,000 or more, provided you qualify for those plans. So you need a TPA, to third party administrator, we call it, to do all those calculations. They do it with the actuary and they come up with the numbers. And if you have eligible employees, of course you have to give them the benefit. You have to really do a cost benefit analysis to see whether it makes sense to give that, to do the DB plan. If your age is higher than 45, 50s, of course it makes sense in that case, but then you have to do a cost benefit analysis for that plan. Now a caller, let me take this quick call. Good evening, Sanjiv Gupta CPA.
Hi, Sanjiv. My name is Srini.
Hi, Srini. Yeah.
So,
go ahead with your question.
Hi. Yeah. So, me and my wife both earn around more than around 400K in W2. So, I was checking is there any way to save the taxes because of the high tax bracket? Are there any other ways? Yeah.
So definitely there are a lot of ways to save taxes. The only thing is we have to really understand and do the things which are creative enough to save taxes, not only now, but also on a long-term basis. So I will suggest to you, again, this is my request, go ahead and register for my webinar, Media Tax Planning. You will get a lot of knowledge, a lot of strategies which you are looking for this year and going forward. Okay, thank you.
Okay. When is it? On
August 21st. You just go to my website, sanjivcpa.com. It is happening on August 21st. This is Saturday.
Okay.
10 a.m. to 12 noon. Okay. Thank you for the call. So we are coming to close very close to this end of the show, but I'm getting calls here. But let me finish my thought process here. So when we're talking about defined benefit plan for the LLCs as corporation, definitely those plans have to be looked into. A lot of people come to me and say they have they don't even know. Their CPA never told us, their financial plan never told us defined benefit plan exists. No, they do exist. And then on top of it is the executive bonus plan, which is like a kind of a non-qualified plan, which can be taken by the owners if they qualify. That's the word. If they qualify, they don't need to give it to employees. But then those are non-qualified. They have to you really need somebody to look into that and make sure that plans is properly documented and compliance is done properly. So definitely those are the areas where you can look into those retirement plans. If you make a lot of profit, remember, defined benefit plan are meant for those business owners who have profit not only in 1 year. They're looking for at least profit for at least 3 to 5 years or more. So it's a long-term plan, but it's a catch-up plan. So definitely that those areas can be looked into. Or you can combine the 401 defined benefit cash balance with cash balance plans. In fact, that is even better. An executive bonus plan, and also you can look into SAP IRAs and other things which are very, very efficient plans. So next week, Wednesday, I will bring in another aspect of corporations, which is about reviving the corporations. A lot of people, a lot of business owners, they have those corporations, but when they start filing, they found out when they go to Secretary of State website, they find out their company is suspended. How to revive it? What are process to be involved into it, and how to move the entity if they move to a different state? How to move it? Let's say formed in California, now they move to Texas. How to move it? So we're going to cover all that. Listeners, if you have more questions, you can email me at sanjivcpa.com. Go visit my website, sanjivcpa.com, sanjivcpa.com. With that, I want to thank all of you for listening to my show today. And if you have any suggestions, do email me at sanjivcpa.com. Thank you very much.
Thank you for tuning in today to Dollars and Cents, hosted by Sanjiv Gupta CPA. Tune in next Wednesday and every Wednesday at 6:30 p.m. If you have any questions about the program or its related topics, you can get in touch directly with Sanjiv Gupta CPA by calling 510-825-7563. That's 510-825-7563, or visit sanjivcpa.com.